Welcome to Animal Spirits with Michael and Ben. In William Bernstein's The Four Pillars of Investing, which is probably one of my favorite books on understanding markets and portfolio management, I didn't read it until probably 2009 or 2010, but it was published in 2002. And he was writing as the markets were still mending from the aftermath of the tech bubble. And for some reason, this piece stuck out to me because we had just gotten through the great financial crisis. So reading this at the time really just stuck in my head. So he wrote, "The great internet bubble will not be the last of its kind, but if history is any guide, we should not see anything approaching it until the next generation of investors takes leave of its senses sometime around the year 2030. If the current generation gets caught out again, we should be very disappointed, as no previous generation has been so dense as to have been fooled twice. But then again, the boomers have shown a singular talent for gullibility, and there is still plenty of time." And so obviously when I read this after the financial crisis, I thought, like, wow, that's crazy that we had one so close to it. But now, 20 years since the tech bubble, we're seeing the same exact thing play out that did in the late 90s. So tech stocks are going crazy. Everyone is day trading. People say we've entered this new paradigm in this new economy. Buffett's getting mocked left and right. IPOs are on fire. Value is getting crushed.
And SPACs.
Yeah, SPACs are going crazy. Small caps are getting left in the dust, and value is getting crushed. That's the exact same description of what happened in the late 90s, to a T.
So history is rhyming.
Right? I mean...
But history is not, or the present is not written yet, right? So we don't know how this is going to play out.
Yeah, and obviously, that was the greatest economic boom of all time, or one of them, and this is a pandemic. And, is it too easy to have it play out the same way on the other side of it?
Well, what if the moment that we're in, I hesitate to call it a bubble, but for lack of a better word, let's just call it a bubble. And let's just say that it bursts. The Zooms of the world, DocuSigns, you know the names. What if they go down 50% or more and the stock market doesn't blink? What if it doesn't take down the rest of the market? The market crashing brought down the economy in 2000.
Right, even though it was just kind of a minor recession at the time. And obviously the economy is the big wild card here. That's the thing that's totally different. But the thing he talked about, how you have to wait a generation. In the past, that's how it worked. Like the Great Depression stayed with people for decades and decades. And the 70s, too, it stayed with people for a long time. They're worried about inflation. Don't you think that technology is the new variable that, like, when people say history doesn't repeat, but it often rhymes, but the one constant is always human nature, but isn't technology making human nature just putting it on steroids, basically, and it's happening so much faster, so these cycles are just speeding up, and people just don't have time to think through things that technology is making. And obviously there's other factors at play with this one, but isn't technology just compressing cycles, and they happen much faster than they ever would in the past?
It seems so. I mean, we had the fastest bear market ever, quickest recovery ever.
Here's the thing. Like, people would have been bored any time in history if you would have shut down the economy like this, but they wouldn't have had access to trading stocks on their phone. You know, in the past, the stock market probably would have just shut down if it happened in the,
So would the economy would have completely shut down. People were still able to function. Businesses were able to function because of Zoom and Slack and technologies like this.
So I think it's the double-edged sword of technology, that I think it's just amplifying our human emotions, and any of these relationships in the past that you could have looked at to how markets would react, I think you have to they've just been put on a ludicrous speed at this point. And I think it's just making it harder to think through these different market cycles. So you had an anecdotal story the other day about a plumber who came to your house and showed you his portfolio.
I was upstairs in my home office. It was, I guess, 8 o'clock at night. I'm writing a blog post on the reason why people are trading. Of course, it's the quarantine. Of course, it's the free commissions and the Portnoy effect and everything else. But the number one reason, plain and simple, like, all of those conditions could exist, but if it wasn't for this one thing, the fact that stocks are going up a ton, people wouldn't be trading. So I was looking at stocks and the move that they made from the bottom, and I think 17% of the Russell 1000 at least doubled off their lows. The best performing stock is Wayfair, for example, up 800-something% since its bottom. And I want to share with you my favorite description ever of the late stages of a bull market. This is from the pseudonymous Adam Smith in a book called Super Money. He wrote, "We are all at a wonderful ball where the champagne sparkles in every glass and soft laughter falls upon the summer air. We know by the rules that at some moment the Black Horseman will come shattering through the great terrace doors, wreaking vengeance and scattering the survivors. Those who leave early are saved, but the ball is so splendid no one wants to leave while there is still time, so that everyone keeps on asking, what time is it? What time is it? But none of the clocks have any hands. And I followed that up with, it sure feels like the clock is about to strike midnight. And the reason why I wrote that is because as I'm writing this post, we have a plumber at the house. We have some work being done in our washer and laundry. And he walks in and he sees me writing, and maybe I had a chart on my screen. I don't know. He goes, do you do stocks?
You must have been doing some technical analysis on your computer, huh?
So he said, do you do stocks? So I said to him, what do you got? And his eyes absolutely lit up. He takes out his phone and he starts showing me his stocks. And it's exactly what you would expect. Nikola, Lyft, Tesla, the usual suspects. You know the names. What should I do? And I'm like, whoa. What do you tell me what you've been doing? Like, fill me in. He said, I've been trading for 4 months. I got 130 grand in the market, and I've got absolutely no freaking clue what I'm doing. And I said,
honestly,
to him,
getting to that point where you can admit that is the first step almost, right?
I couldn't believe it. So I said to him, this is nuts. I'm literally writing a post about you. No offense. Don't take this the wrong way. I'm writing a post about you. And this was my very own shoeshine boy moment. Joseph Kennedy allegedly said, when the shoeshine boy is giving tips, you know the top is near, or something like that. And I don't think you necessarily need a retail frenzy for the market to top. But every time you have something like this, there has to be some sort of a top coming. And when I say top, I'm not suggesting that the market necessarily is going to top. And obviously this has to be taken with a giant grain of salt because nobody knows where we are in the cycle. Nobody knows what time it is. But man, this feels like we're getting pretty close.
My problem with, and I tried to talk about this last week, I tried to give people the benefit of the doubt because we've been hearing anecdotes like that for so long.
But we've been hearing anecdotes about this. But the anecdotes that we've been hearing are Kenny G, Mila Kunis, the Mike Tyson app, Aaron Rodgers VC. But it's never. We haven't had anecdotes where it's literally a retail frenzy mania.
Yeah. Oh, I trust me.
Right?
I'm there. So the Wall Street Journal, they said at E-Trade, investors opened up more than 260,000 retail accounts in March alone, more than any full year on record. And so they interviewed this one woman who said, "Scared money makes no money," which sounds like she got that right from the school of Dave Portnoy. She says, "I feel like Sonic the Hedgehog collecting my coins," referring to obviously the old video game. She said she buys box of stocks that trade for less than $5 a shares and sells many of them within a day or two. Doesn't even consider conventional stock picks. Obviously, these stories are crazy.
Share the other one, the former police officer. This guy is a former police officer turned real estate broker who said he has been making steady six figures since 2010. Now he boasts of how he says he turned 20 grand into more than 450,000 without any prior trading experience. Listen, not going out on a limb. We know how this ends, right? Like you and I are the type of people that scoff at people who say this ends badly, but come on.
Of course.
This ends
badly.
This
definitely ends badly. I just don't know when it ends and how spontaneous it's going to be. Yeah. Oh, yeah. That's just because this whole bull market behavior was like, it was spontaneous. It was building and building and building, but then this happened and it just took off.
So let's say that you use these anecdotes and you say, you know what, I don't want to play anymore. Meaning, I don't even want to invest anymore. I don't want to be in the market because this is nuts. It's going to crash. Look at the retail activity. By the way, TD Ameritrade, same thing. Average client trades per day up 300% year over year. 661,000 new retail accounts. So it's everywhere. It's everywhere. The top 15 trading days in the firm's history were 10 of them were in June alone. Okay, so it's everywhere. It is absolutely manic.
Okay, so let's say these stocks get killed, all these new retail traders get killed. I mean, these aren't big money people anyway, for the most part, right? Not all of them turn 20 grand into $1 million or whatever. I'm saying on the individual level, is the pain not as great as it would have felt otherwise?
My point is, hold on. The point that I was trying to make is, what if you say, I want to get out of the market. I'm going to liquidate and I'm going to wait for the crash that is inevitably coming. What if that doesn't happen? What if you get the crash in the DocuSigns and the Teslas and whatever, but the market necessarily doesn't crash? And how long can the average person, and this is an overgeneralization, but how long can you wait in cash before, you know what I mean? Before you're just completely poisoned and your long-term results are ruined forever. What if you wait 2 years in cash? What if you wait 1 year?
There's a reason to not invest in anything right now, because you say, okay, just invest in the tech stocks, the S&P, then the other side of that is, well, no, those are way expensive and they're just being led by tech stocks. And you go, okay, well, why don't you invest in small caps or value stocks? And you go, no way, those are down for a reason and those getting crushed. Okay, well, invest internationally or in emerging markets. And you say, no way, they don't have the tech stocks like we do in the U.S. So, and then you get to bonds and it's like, well, bonds have low interest rates. So there's a reason against investing in anything right now, right? So the most boring answer in the world is you diversify, right? The thing that no one wants to hear about. But yes, but these gambling people are not going to do that. And maybe it's the thing that sports never comes back for them because all the sports teams are testing positive for COVID right now, so they won't be able to make the parlay into sports gambling again. But I don't know. I mean, yeah, historically, these people always get crushed, and that's just what happens. So
last week, you tried to give Robinhood traders, or traders, I guess, just the benefit of the doubt that maybe they're smarter or they're not going to write it all the way down or whatever. And we got an email, Ben is wrong. Somebody said, a couple of kids I went to high school with invited me to join a Facebook group called Let's Talk Stocks. 3 dozen guys, most barely graduated high school. And here they are giving each other tips and options and big pre-market movers. They trade stocks I never even heard of, and I follow the market pretty closely. It's wild. So I'm pretty anti-forecast and stuff like that. And not that you should ever act on intuition or anything like that, but I'm pretty comfortable saying that the end is near for these stocks.
Yes, my whole thing about this is crazy that it happened this year. I still can't wrap my head around it. Obviously, I know human behavior, like this is the stuff that we study and you read all these psychology books, and I get the reasons now.
But this is rational. It's totally rational.
I know, but I'm just saying, 4 months ago, we were talking about the stock market as we know it coming to an end, basically. And now we're talking about or just going down 70% because the economy was heading for 40% unemployment. I'm still having trouble wrapping my mind around that this actually happened.
When I say it's rational, in no way, shape, or form do I mean that I anticipated this. But when you think about what transpired, the extra $600 a week, the free trading, the Portnoy effect, and the fact that the stocks that are going absolutely bonkers are Tesla and Peloton and Wayfair and Slack and all these names that are A, benefiting, but B, names that like these people, these users know intimately. But
this is total hindsight bias on your part and my part, though, because when those $1,200 checks were announced, no one said, "Oh, this is going to the market. That's what's going to happen." No one predicted that at all.
I just said that I didn't predict that, but just because it's hindsight bias doesn't mean it's not rational. I'm just saying the way that we got here. I'm not saying that it could have been foreseen 90 days ago. I'm just saying that the chain of events makes sense when you put them together.
It definitely does, and I understand why it's happening. It's just I can't
crazy.
believe we went
doesn't
from
make
Great
crazy.
Depression to 90s. I still am having trouble wrapping my mind around it because it is so wild. The books in this are going to be so
crazy. Look at
crazy.
these next charts. Cumulative global sector fund flows. And everything is pretty much flat-ish, flat to up or down. Technology, obviously, just vertical. It's taken in $40 billion over the last 12 months. There's another chart showing, and we showed a version of this, NASDAQ volume divided by NYSE volume. Absolutely going vertical. So I was talking to Josh about this, and he made a really good point that, by the way, Josh Brown was talking about SPACs on his podcast and where we are right now in the cycle, and it was really excellent. We'll link to that in the show notes. Highly recommend it. And we were talking about how this ends, and he made a point that I thought was counterintuitive, that we always think that it's retail that causes the crash. That it's, and it is to an extent, it's retail, going in and there's nobody left to buy. Everybody's on the same side of the boat. And then we know what happens. But what actually happens is the special purpose acquisition vehicles and things like this. It's Wall Street responding to the demand with a tidal wave of supply. That's how these things end.
So the exact same thing happened in the South Sea bubble, the 1700s. They had a couple companies that went bananas, and then all these other companies started forming out of nowhere. It's the same exact thing. It happens in every boom, right? That then they just flood the market with more securities, and at that point, the demand can't soak them up anymore, and then it's see you later, right?
You think that there's going to be anybody on the big short side of this, assuming that we see a crash? I don't think that that's going to happen. I think that's too difficult.
I think most of I'm sure a lot of it, people like to blame it all on retail, but there have to be pros and institutions that have hopped in on these trends as well. This can't be all retail.
On the long side.
Yes, right. So I'm saying these professional investors are probably going to get hurt in some ways, right, with retail. Maybe not nearly as bad, but they're definitely there too.